picture this. You're standing in your kitchen at, I don't know, maybe 7 in the morning.
Right, half asleep, making coffee.
Exactly. And you're pouring a scoop of this premium grain-free kibble into a bowl for your golden retriever.
Yeah.
But while the dog eats, you pull out your phone, take a sip of that coffee, and you approve a really complex payroll request for the 100-person company you manage.
It's two completely different actions.
Two totally separate worlds. I mean, one is this messy, emotional reality of pet ownership, right?
Yeah.
And the other is this super rigid, highly regulated sphere of enterprise human resources.
Yeah, and looking at it from the surface level, you really couldn't find two more divergent sectors of the 2026 economy.
No, definitely not.
I mean, you have discretionary consumer spending on one side and then totally mandatory corporate overhead on the other.
But so since you sent over this stack of late March earnings reports, we've been really digging in.
Oh, yeah, we have.
And the underlying business mechanics shaping those two very different moments in your morning are actually shockingly similar.
They really are.
Okay, let's unpack this. Today, our mission on this deep dive is to pull apart the strategies of two vastly different giants. We've got Chewy, the consumer pet e-commerce behemoth, and Paychex, the B2B HR and payroll titan.
Right.
We are going through the market research notes from Chewy's Q4 fiscal 2025 and a transcript of Paychex's Q3 fiscal 2026 earnings call that you shared with us.
And, you know, we aren't just rattling off a random assortment of financial metrics today.
No, definitely not.
By looking at these two specific reports side by side, we are actually taking a real-time cross-section of the macroeconomy.
Yeah, which is so valuable right now.
It is. We are observing exactly how management teams are attempting to engineer their own success despite a highly dynamic, frankly uncertain environment.
Right.
What you'll see is that both are fundamentally attempting to change their corporate identities.
And move away from being simple top-line growth engines.
Exactly. They want to be seen as durable, highly profitable margin compounders.
Right. But before we can really analyze the mechanisms of how they are pulling off these, massive strategic shifts, we have to look at the scoreboard.
We need a reality check.
Yeah, a reality check on the actual numbers they just posted. So, let's look at Chewy first.
Okay.
They reported their fourth quarter pulling in $3.2647 billion in revenue.
Which is a very specific number.
Very specific. And that's up about 8.1% year over year when you normalize it to account for an extra week in the prior year's calendar.
Right, you have to adjust for that extra week.
Exactly. Now, their standard accounting profit, their GAAP EPS, came in at 9 cents a share.
Which is basically exactly what Wall Street expected.
Yeah, right on the nose. They did have a tiny miss on the non-GAAP adjusted EPS at 27 cents.
And that excludes some one-time costs.
Right, but overall, analysts universally called the quarter fine rather than spectacular.
Which, is a very measured response.
Yeah.
It wasn't a catastrophic disaster, but it certainly wasn't a blowout quarter that usually sends a stock soaring,
But here is the crazy part that caught my eye when reviewing your notes.
Oh, the stock reaction.
Yes, the stock actually reacted really positively. The market completely looked past the fine fourth quarter.
And why is that?
Because of their fiscal 2026 guidance.
Oh, yeah.
They projected $13.6 to $13.75 billion in forward revenue and roughly 100 basis points of margin expansion.
Which is a huge deal.
It is. Just to translate that finance jargon for a second, 100 basis points is exactly 1%.
Right.
But when you are dealing with nearly $14 billion, expanding your profit margin by a full 1% generates massive free cash flow.
It's transformative money.
Exactly. It reminds me of an old analogy, actually.
Let's hear it.
Earnings reports are kind of like a student's pass report card, but forward-looking guidance is the college application.
Oh, I like that. That's a great way to look at it.
Right. Wall Street completely forgave a mediocre report card because Chewy's college application for 2026 looked incredibly promising.
What's fascinating here is the contrast and how these two companies actually arrived at their forward-looking confidence.
Yeah, it's super different.
Very different. For Chewy, the broader market has been actively debating whether a pet retailer could ever re-accelerate its top-line sales growth without relying on inflation.
Right, without artificially pushing prices up.
Exactly. Management had to use this call to reassure investors that growth was coming from real, organic customer momentum.
Which is a tough sell sometimes.
It is. But then you look at Paychex's numbers. They didn't have to reassure anyone about a fine quarter because they delivered an absolute blockbuster.
They really did. 20% revenue growth, hitting $1.8 billion.
Incredible.
And their adjusted operating income was up 22%.
And when you dig into the mechanics of that 20% growth, you see they are pulling this off in what management explicitly called a low-fire, low-hire environment.
Which sounds kind of bleak, honestly.
Well, it means employment levels across the country are flat. Companies aren't doing massive layoffs, but they also aren't aggressively expanding headcounts.
They're just holding steady.
Exactly. Yet, despite operating in a totally stagnant labor pool, Paychex is boasting a 41% rolling return on equity.
Wow.
And they just launched a massive $1 billion share buyback program.
That 41% return on equity is a wild metric.
It really is.
For anyone listening who doesn't, obsess over balance sheets, return on equity basically measures how efficiently a company generates profits from the money shareholders have invested.
Right. It's a pure efficiency metric.
Hitting 41% shows unbelievable capital efficiency. So both management teams are projecting immense confidence.
They are.
But I keep coming back to the mechanics. How are they actually generating these numbers when the economy is so unpredictable?
That's the billion-dollar question.
Because you can't just cross your fingers and pray that families buy more squeaky dog toys.
No.
Or that small businesses randomly hire more middle managers.
Hoping for macro tailwinds is not a viable business strategy.
Definitely not.
And that brings us to the actual secret weapon both of these companies are wielding right now.
Which is?
The architectural power of sticky ecosystems.
Okay, sticky ecosystems.
Yeah. They aren't just selling a product anymore. They are locking customers into recurring, deeply essential relationships.
Okay, let's focus on Chewy's ecosystem first, because the raw numbers here blew my mind.
The Autoship numbers.
Yes. Autoship, which is their automatic subscription delivery service, accounted for a staggering 84% of their Q4 net sales.
It's massive.
That translates to $2.744 billion on absolute autopilot.
Think about that baseline.
It's crazy. And as we noted earlier, they aren't driving that revenue up by quietly jacking up the price of kibble.
Right. No inflation tricks.
Exactly. Management specifically noted there is very little like-for-like inflation right now. Instead, they're growing by capturing a higher share of the customer's wallet.
Yes.
They're leaning into pet premiumization and heavily expanding into healthcare and vet offerings.
Which is key.
And plus, they notched their 5th straight quarter of active customer growth, hitting over 21.3 million users.
This is the absolute textbook execution of expanding a competitive moat.
Really? How so?
Well, they capture the customer with the pure convenience of heavy dog food appearing on the porch.
Because nobody wants to lug that from the store.
Exactly. And then once you're locked in, they slowly integrate more high-value services.
Okay, but let me push back on the strength of that moat for a second.
Go for it.
Is a pet food subscription truly a sticky ecosystem? Or is it just a luxury of modern convenience?
That's a fair question.
I mean, if you are looking at a household budget and grocery bills get way too high, isn't logging in and canceling the recurring dog treat box the very first thing a family is going to do to save $50 a month?
Yeah, that makes sense on paper.
It just doesn't seem that durable to me.
Well, if the ecosystem was strictly limited to treats, toys, and maybe some generic kibble, that pushback would be entirely correct. It would be highly vulnerable to consumer down cycles. But that's exactly where Chewy's aggressive shift into healthcare, pharmacy, and veterinary telehealth becomes the structural linchpin of their strategy.
Ah, the healthcare pivot.
Yes, it fundamentally alters the psychology of the purchase.
How so?
When Chewy transitions from the company that sends your dog a squeaky toy to the licensed pharmacy providing your aging dog's vital heart medication.
Or like a prescription diet.
Exactly. Once they do that, they move from a discretionary luxury to an operational necessity.
Ah, okay, I get it. The healthcare integration acts as the glue.
Yep.
You might cancel the toys, but you are never going to cancel your pet's insulin.
Precisely. You just won't do it. And if we carry that exact same logic over to the B2B side, you see Paychex doing the exact same thing with corporate HR.
Okay, let's look at Paychex then.
Let's look at their PEO business. PEO stands for Professional Employer Organization.
Right.
In a PEO arrangement, Paychex enters into a literal co-employment capacity with their client.
Meaning they legally become the HR department for these small and medium-sized businesses.
Yes, exactly. This quarter, that PEO segment saw high single-digit worksite employee growth and double-digit market demand.
And as anyone who has ever run a small business knows, managing state-by-state compliance and health benefits is an absolute nightmare.
It is. For a small business, a compliance mistake isn't just a minor headache.
No, it's a disaster.
It's an existential risk that can literally bankrupt you.
Yeah.
So Paychex steps in and handles the withholding taxes, the shifting federal regulations, and the workers' comp.
All the scary stuff.
All of it. But even more importantly, the PEO structure allows a small 20-person plumbing company to pool their employees together with thousands of other companies.
Oh, that's clever.
Suddenly, that local plumber can offer Fortune 500 level health insurance and benefit packages to their workers.
Which helps them compete for talent against massive corporations.
Exactly. And once Paychex is managing your legal compliance and holding the keys to your employees' health insurance, the switching costs become astronomically high.
I can imagine.
You don't just churn and switch payroll providers to save a few pennies when the process requires filing new tax IDs and disrupting your entire staff's medical coverage.
That makes total sense. The pain of leaving is significantly higher than the cost of staying.
Exactly.
And Paychex is taking that ecosystem a step further with a new program called Paychex Perks.
Oh yeah, this was fascinating in the transcript.
Right. It's a digital marketplace where they offer over 25 portable benefit offerings directly to the workers.
Directly to them.
Yeah. In its first 18 months, they've had purchases from nearly 350,000 unique employees.
That adoption rate is incredible.
It is. And these are benefits the employee can actually take with them even if they change jobs. And it requires zero added cost or administrative burden from the employer.
Which the employers love, obviously.
Right. It's brilliant because it bypasses the company entirely and creates a direct, sticky relationship between Paychex and the end user.
It creates an incredibly durable, multi-layered ecosystem.
Yeah.
Chewy locks in the pet owner by moving from kibble to critical health care.
And Paychex locks in the business owner by moving from basic payroll software to complex legal compliance and direct employee benefits. Okay, so step one of the 2026 playbook is pretty clear. Build a moat and lock the customer into a sticky ecosystem where the switching costs are painful.
That's step one.
But once you have them in there, how do you actually extract more value?
Right.
If we are talking about becoming a margin compounder, how do you fundamentally lower your costs to serve those exact same customers?
That is where step two comes in. Deploying highly specific, targeted artificial intelligence.
There we go.
And I want to be incredibly clear here, especially given the hype cycle we've lived through lately.
Yeah, please.
We aren't talking about slapping a flashy AI chatbot on a website that, hallucinates policies and frustrates your customers.
Nobody wants that.
No, both Chewy and Paychex are utilizing AI as an invisible back-end engine for massive operational efficiency.
Here's where it gets really interesting. Let's look at Chewy's internal AI deployment.
Okay.
They told investors on this call that AI-driven productivity is going to contribute in the low tens of millions of dollars in savings for 2026 alone.
Which is real money.
Real money. And by 2027, they expect those annualized AI savings to hit over $50 million.
Wow.
They are pairing the software tech with the physical ramp-up of their next-generation Houston fulfillment center.
And next generation means what exactly?
It means automated sorting, predictive inventory modeling, and drastically reducing the physical human steps required to pack a box.
Efficiency at scale.
Exactly. Management explicitly called this AI and automation deployment a self-help lever.
A self-help lever. I like that.
Right. It's the mechanism driving that 1% margin expansion we talked about earlier.
They recognize they simply cannot wait for the macroeconomy to bail them out with cheaper fuel or lower shipping rates.
Because who knows when that will happen?
Exactly. They are pulling their own levers by structurally lowering the internal costs required to serve each individual pet owner.
Yeah.
But the way Paychex is utilizing AI is arguably even more complex.
I would think so, yeah.
Simply because of the severe regulatory environment they operate within.
I'm so glad you brought that up, because when I was looking at these AI numbers for Paychex, I was honestly a bit confused.
How so?
Well, they are dealing with federal tax laws, state labor compliance, and, people's actual livelihood.
Right.
How on earth can they trust an AI not to hallucinate a legal ruling that ends up getting a small business sued into oblivion?
Well, the short answer is, if they let the AI run autonomously, they couldn't trust it.
Right.
And that is why the Paychex CEO hammered home a very specific, crucial concept during the earnings call: the human-in-the-loop model.
Yes. The transcript was wild on this front.
It really was.
They have deployed over 500 AI-powered capabilities across their business. 500. They're using agentic AI to handle complex voice and email payroll processing.
But it's not blind automation.
No, exactly. The CEO gave this incredibly specific example that just made it click for me.
The Akron example.
Yes. Let's say a client wants to terminate an employee in Akron, Ohio.
Okay.
The labor rules and severance requirements in Akron are highly specific, and local court rulings change constantly.
It's a moving target.
Exactly. Now, AI is incredible at scraping the latest Akron municipal court rulings and cross-referencing state laws in a matter of milliseconds.
Way faster than a human could read them.
But Paychex does not let the AI pull the trigger or automatically email the client legal advice.
That would be a liability nightmare.
Total nightmare. Instead, the AI serves up a customized, hyper-accurate, synthesized brief to a human Paychex HR expert.
Yeah.
That human expert reads the brief, verifies it, and then gets on the phone to advise the terrified small business owner on exactly how to proceed safely.
It's a great workflow.
I love this model. It's like an Iron Man exoskeleton.
That is the perfect way to conceptualize the human-in-the-loop model. The technology isn't designed to act independently.
Right. The AI isn't a robot coming to replace the HR worker. It's a technological suit of armor.
Exactly.
It makes the human HR expert infinitely faster, smarter, and far more capable of handling complex legal issues at scale without burning out.
And if we connect this to the bigger picture, the business implications of that exoskeleton create a nearly insurmountable competitive advantage.
Really? How so?
Well, for Paychex, there is a massive data flywheel effect happening.
Okay, unpack that.
To make enterprise-grade AI actually work without hallucinating, you need massive amounts of structured and unstructured training data.
Which Paychex has.
Right. Paychex possesses a proprietary data set built on decades of HR interactions, millions of payroll runs, and countless compliance inquiries.
Yeah, you can't just buy that data.
No, you can't. And every single time a client asks a new question or an Akron law changes, that data feeds back into the system.
It updates the whole network.
It makes the AI smarter, which in turn makes the human experts more proactive.
Meaning a brand new Silicon Valley startup can't just write some slick code, raise some venture capital, and instantly compete with them.
They absolutely cannot. A tech-only startup might have phenomenal algorithms, but they don't have the historical proprietary data of a million hyperlocal employment scenarios.
Right.
Nor do they have the seasoned army of human experts to actually interpret that data.
Which is the most important part.
Exactly. By using AI to automate the routine transactional support, like answering basic tax code questions, Paychex frees up their human staff.
To do what?
To spend their time on higher value, proactive advisory work.
Which perfectly sets up the final piece of the 2026 puzzle for both of these companies.
Fundamentally shifting the corporate narrative.
Exactly. When you combine those sticky, high switching cost ecosystems with the margin expanding power of AI efficiency, management gets this really rare opportunity.
They do.
They get to completely change how Wall Street and more importantly, their clients perceive their core identity.
And altering your corporate identity is incredibly difficult.
Oh, yeah.
But if a management team can successfully change the market's perception of what kind of company they are, they can drastically change the multiple at which their stock is valued.
We saw this vividly with Chewy's stock reaction.
Yes.
The market wasn't just rewarding a slight bump in future revenue guidance. Wall Street is actively buying into their narrative shift.
They are.
Chewy is aggressively moving away from being viewed as a low-growth e-commerce retailer, which, let's be honest, is a category nobody wants to invest in right now, given the dominance of Amazon.
Yeah, that's a tough place to be.
Right. Instead, they're successfully rebranding themselves as a durable customer and margin compounder.
That phrase right there, a margin compounder, implies predictability, resilience, and an ability to generate cash flow, regardless of whether the broader economy is booming or busting.
And Paychex is executing almost the exact same narrative pivot, just in the B2B space.
Yeah, they are.
They are pushing hard to move away from being seen as merely a traditional tech and payroll processor.
They want to be recognized as a comprehensive HR advisory firm.
Right. And the key mechanism to achieve this was their strategic acquisition of Paycor.
Now, Paycor is interesting.
It is. It's a brand specifically tailored for the enterprise market, meaning companies with 100 or more employees, rather than the tiny mom-and-pop shops Paychex traditionally served.
The integration of the Paycor brand was heavily emphasized on their earnings call.
I noticed that.
Because moving upmarket into the enterprise space brings higher margins and significantly longer client retention.
And the data shows it's really working.
It is.
Their bookings and broker referrals in that enterprise segment have accelerated all the way back to pre-acquisition levels.
That's a huge win.
It is. What they were doing now is aggressively cross-selling their higher margin services.
Like the PEOs we talked about.
Right. We already talked about PEOs, but they are also pushing ASOs.
Administrative Services Organization.
Exactly. Where they manage the complex HR software and functions without taking on the legal co-employment risk. Plus, they are bundling in their retirement and 401k solutions.
It's the full package.
So what does this all mean for you, the investor or the business owner listening right now?
Good question.
Are these companies actually rebuilding the engine of their business, or are they just, putting a new AI bumper sticker on the back of the same old car to keep their stock prices up?
Well, looking at the mechanics we just outlined, I would argue they are genuinely rebuilding the engine.
Do you think so?
I do. The core product delivery is fundamentally changing.
How?
Well, Paychex noted that they are now offering do it for you or do it with you, managed payroll and benefit services to companies with 500 employees.
Which is huge.
Historically, a traditional software company would just sell you the annual license, hand you a manual and say, good luck, here's the tech support number if the software crashes.
Right, you're on your own.
Now, Paychex is actively stepping in to augment or entirely replace an understaffed corporate HR department.
Yeah, that is stepping far beyond mere software provision.
They are evolving into a dedicated services partner, which is simply powered by software.
Exactly. And Chewy is executing the exact same evolution on the consumer side.
They are.
They aren't just a logistics company shipping cardboard boxes of food anymore. They are integrating themselves into the entire life cycle of a pet.
From puppyhood to senior care.
Right. From the day you bring a puppy home and set up the Autoship, to the day you need complex veterinary advice, telehealth consultations, and prescription medications.
It's all connected.
The DNA of both companies is actively evolving from transactional interactions to deep relational partnerships.
That's the key right there.
Okay, let's bring this all together.
Let's do it.
Whether you are selling premium dog kibble to consumers or managing corporate payroll for enterprises, the blueprint for corporate success in 2026 seems to be completely identical.
It's striking how similar they are.
Step 1, you have to build a sticky ecosystem that your customers literally cannot operate without, raising the switching costs so high that leaving is painful.
That's the moat.
Right. Step 2, you deploy artificial intelligence quietly and specifically as an invisible exoskeleton to boost your internal productivity and profit margins.
The self-help lever.
Exactly. And step 3, you use that freed up cash flow and operational bandwidth to move upmarket, shifting your identity to offer higher tier advisory or healthcare services.
It is a phenomenal, highly durable blueprint. And based on the earnings reports you shared with us, it is clearly working for both of them.
And for your own portfolio, or even looking at the company you work for, these are the exact mechanical levers you should be evaluating.
Absolutely.
Is the organization building a moat? Are they using AI to make their human talent faster and smarter? Or are they just lazily trying to replace them?
Right.
Are they shifting from selling one-off transactions to selling trusted, recurring advice?
And this raises an important question to leave you with as we wrap up.
What's that?
We've talked extensively today about how these specific companies are using AI as a self-help lever to expand their margins.
Yeah.
But let's look further down the road. If every scaled company eventually implements these exact same AI workflows, if every corporation eventually builds an Iron Man suit for their employees, does the competitive advantage of artificial intelligence eventually zeros out?
Wow, that's a wild thought.
Right. When hyper-efficiency becomes the baseline expectation rather than the exception, will the ultimate differentiator simply revert back to whoever has the best, most trusted human-to-human relationships?
It really does all come back to trust, doesn't it?
It really does.
Whether you are trusting a human expert with the legal livelihood of your employees or trusting them with the long-term health of your golden retriever.
Exactly.
Well, thanks for sending over the notes and thanks for joining us on the deep dive. We'll catch you next time.